Let's talk about the market reaction to all of this. Joining us this morning, Paul Hickey, co-founder at Bespoke Investment Group. Paul, it's great to have you back. Good morning.
Good to be here. How you doing, Carl?
I'm good. Meantime, Hassett's on the tape as well. Do not expect mass layoffs from AI. How would you judge the market's ability to sort of game out all of these crazy long-term cross currents?
I think there are a lot of cross currents, and as we're talking about, there's no official employment data. But getting back to your conversation, you were talking about with the jobs. The JOLTS numbers today were better than expected. Sure, the quits rate was low, but it was October. We're in the middle of a government shutdown and a lot of uncertainty, so you can understand that. But other data, too, that we've seen. We saw an ADP National Employment Weekly update today, which showed the first positive reading in 4 weeks. The NFIB employment-related numbers today collectively showed the best improvement since last November. Jobless claims last week saw a sharp decline. Yes, it may have been holiday-related, but even if you adjust for some of those distortions, it was still pretty good. Continuing claims also fell. So I think on the whole, the labor data that we're seeing points to improvement. And as you were talking about the pressure on the lower-income consumer, this improving employment-related data should translate to a better outlook on the lower end. And then getting back to the market's interpretation, just look at some of these consumer-facing stocks, what they've been doing lately. You see dollar stores, you see department stores, you see apparel stocks. All these stocks have been ripping higher. Auto stocks, Ford and GM are right near new highs. Even used car stocks, which have been under pressure, have been rebounding. So I think, there's been a lack of official economic data, but the market is sensing something here because these consumer-facing stocks are doing well.
Yeah, and to your point, I think since the shutdown, most data releases have beaten, and the argument yesterday was that's what took the 10-year to 418. I wonder how much higher you think it could go.
Yeah, we've seen a big uptick in the yield over the past couple of weeks here, but since the Fed started started cutting rates again a few months ago, it hasn't been anything like this surge in rates that we saw last year when they were cutting. Excuse me.
Yeah.
So I think I wouldn't get too worried about that at this picture. I think if you're under 4.5, the market can handle that pretty well. So in that respect, you look at the 10-year yield on a 1-year range, it's still much closer to the low end of its 1-year range than the high end of its 1-year range. And when we couple that with oil right near 52-week lows and the dollar near the low end of its historical range, when you see all three of those together, we call them the three-headed monster. When they're all at the low end of their range, the forward returns for the stock market historically have been exceptional. So there are, sentiment, you can say has gotten, strategists are very bullish on the year ahead, but I guess there's reasons why at this point that they are bullish.
I guess it's good news if yields are rising because the outlook is improving, but is it a problem that the Fed is cutting while yields are rising?
Whatever I say about the Fed will cause people to question things. But I think it's been well telegraphed at this point that they're going to cut tomorrow. So I don't think you can really change course now. But again, Sarah, last year when they were cutting rates, the 10-year yield was going up so much more than it's been going up during the last after the first 2 cuts during this period. The uptick that we've seen is only just in the last couple of weeks here.